Hi, welcome to Urban Insights. I'm Jayashree Kuru. Today we're talking about a subject that is very relevant in the current context because the Indian population is aging. So we're talking about senior living, how senior living facilities are coming up, and also addendum to that, we're talking about reverse mortgage. Is reverse mortgage a financial instrument that needs to be evolved much better to make sure that senior living is successful? And with me are Professor Prashant Das from IIM Ahmedabad. Thank you for joining us. Mr. R.V. Verma, the person who actually introduced reverse mortgage into the country as the Chairman and Managing Director of NHB. Thank you so much, sir, for joining us. And Mr. Anantram, he's from Manasam Homes. So thank you so much for joining me. And let's start the discussion with Mr. Verma. Mr. Verma, when we talk about reverse mortgage, tell us what the thought process was then. And today, what are the tweaks that are required in this policy for it to move into the next stage?
Hi, Jashri. Hi, panel speakers. This is very interesting subject, actually, and it has a lot of passion around it, a lot of emotion around it. So when in the National Housing Bank, we did come across this product, which was doing well in other countries, in other jurisdictions, and specially designed for the purpose of the senior citizens, the aged people who would be having a home, but very little cash flows to really, support themselves and to support the expenditures in a decent measure. So we had thought about a home which was built through a mortgage from a lending institution. And that market was pretty developed, very well developed, the primary mortgage market, as we used to call it. But then a person who was having a home already, and he was living in it, and he would want to continue to live in it till whatever time, he'll be an aged person. We were wondering, how we can use such a valuable asset as a home to generate some cash flows for the person. So that was the initial thinking. And that's how we came across, of course, we knew that there's a product like reverse mortgage loan, which was actually happening and existing in other jurisdictions. So we did some studies, we did learn some lessons, from the other countries' examples. And we did a pretty huge, market survey across the country. Because reverse mortgage is something which has a lot of emotion around it. It has a lot of family and joint family thoughts and sentiments around it. So we thought it was best to test the market with what people would think about it. So we got a fairly favorable response, though it was a very new product. So we had a little difficult time explaining the nuances of the product to the whole different segments of the population. The short point is that, yes, we tried to put in place a product which would mean essentially cash flows, which will give cash flows to the people till their entire life. And that cash flow will be supported by the value of the property. There is certain value which is embedded in the property, and there's financial value actually. So we wanted to, how could that be unlocked for the people to get a stream of cash flows for the rest of their life to both support the maintenance of their property and also to support their lives. So that's how we thought about it. And then we tried to put it in the context, where the lenders would be involved, the insurance companies will be involved, because something which a cash flow which comes for the entire lifetime has to be in the form of annuity, because it has certain risks. For the lenders, there is certain amount of risk, legal risk. It has, credit risk, default risk. For the insurance companies, it's longevity risk. So it had to be a very well thought out product with the participation of all the collaborating agencies, like the borrowers, of course. The person who is living in that house is not exactly a borrower. I mean, he is borrower to the extent that he has mortgaged his property, but against that mortgage of the property, he's getting a cash flow, a monthly cash flow or quarterly cash flow or one-time cash flow, depending on the, how flexible the product is. So it's called reverse mortgage because in a regular forward mortgage, a regular mortgage, the person actually has to pay a monthly payout to the lenders, while in this case, he is getting a monthly pay-in from the lenders against the mortgage of the property. So it was designed to suit the needs of the senior citizens, and rightfully so, because many of these parents, though we have a joint family and the Hindu undivided family, etc., and a lot of children, even though they are staying abroad, they would like to support their parents. But then parents also, having self-respect, and they would feel that they will live with all dignity and reasonable self-respect, and they have a property with themselves. So there was a good feeling about this product across the senior citizen community in different parts of the country. Naturally, those areas, those states which are more kind of commercially savvy or commercially aware, the product found greater favor as compared to a few other states where the financial aspect, or where we had more embedded undivided family, or more embedded sentiments around the property not being mortgaged, or property going to the for the heir only. So we had to build in all those sentiments in this product, and the product is designed to address the financial needs of the individuals, is financial security, emotional security, legal security of the property, and also the possibility of the property passing on to the heirs in case they are prepared to pay the debts to the lenders. They'll have the first right. So overall, if you look at the whole package, it was a kind of all the rough edges were smoothened, and we tried to address the different needs of the individuals, the lenders, the insurance companies, the risks also being packaged in such a way and addressed that it was kind of allowing a pretty decent cash flow for the individuals. Of course, depending on the value of the property, that was key. That was very critical. So we had a whole lot of exercise. We had awareness building. We had campaigns. We had actually set up mortgage counselors, reverse RML counselors, reverse mortgage loan counselors across the country, and we used to be sensitizing the senior citizens through their RWAs, welfare association programs, through visits to the parks, where they normally meet. So that was it, and we short of getting a good support from the government. In fact, government was also kind of being sensitized to supporting this product, the senior citizens, and which was very important. So we had the government participation as well, where the government had come in with a good amount of fiscal measure in terms of the cash flows coming to the individuals being exempt from the tax, particularly the senior citizens under the RML, and which was notified by the government. So we had done a good amount of fair amount of work. We need to build on that, and somehow the product didn't develop too much. They didn't really, but we had all the lenders sensitized. The National Housing Bank had issued guidelines to the lenders. It was discussed across the lending industry, the banks, housing finance companies, and the insurance companies. And that's how the product was, designed for the first time and launched.
And a very early product, I would say, ahead of its times, because 1998, the market was just opening up. The first housing and habitat policy have just been evolved. So, senior living as a concept, aggregated senior living, had not taken off. Now, let me go to Mr. Anantram. Senior living is a 5 to 10-year-old product mostly in the country. I think certain operators have been working for longer than that. But the whole idea is that here you are servicing a category of people. Like Mr. Verma said, they had to go to parks and RWAs to sensitize the seniors. Today, the seniors are coming to certain people, and that is people like you who are offering specialized products. First, what stage do you think we are in the senior living community building? And the second thing is, how do you see reverse mortgage, especially in the light of these assets being built, especially for the category, the target community?
So, first and foremost thing, I want to thank Mr. Verma for such a visionary thought at that time. Okay, I mean, with a lot of gratitude to you. I just want to say that, I mean, this is, in fact, every other point what you mentioned, be it a financial security or an emotional security or a self-respect. I mean, these are the, these thought process behind the product, that itself shows that this is not a regular commercial product, right? I mean, the entire product has been built around emotion. So that's really hats off to you for thinking about this several years ago. Okay. So now coming to the requirement, like the kind of the need, if you look at the reverse mortgage, this is very important in today's scenario, because as Mr. Verma said, the seniors, when they have accumulated such a good properties, because they would have worked throughout their life to earn such kind of a property, and then sometimes they will have this challenge of the liquidating the property, and then they don't know how to approach. Or even if they do that, are they really doing a right thing or not? Or are they not getting into the hands of the wrong people? So they will have a lot of these fear. In fact, I have seen in some of the places where they'll be having a very big properties, but will be living in a very meager and an average way. Okay, their lifestyle will be very average, but the properties will be worth several crores. Okay, so I'm sure for those kind of situations, this has come in like a bone. And similarly, as you know, like whenever you get into the places like either in a senior living or into your own house, year on year, your the need, in the sense because of the inflation and various other factors, the need for the cash flow are becoming higher and higher, like as compared to the previous year or whatever is a thing. Yeah, so that way, this is really a big boon to this society, and this is a definitely much needed product. So that's and especially in the as you said, in the senior living concept might have come the recently, but the thing is, it has been there. Like for example, in the earlier days, what used to happen, my parents, they would have moved from villages to the bigger towns and cities where there will be a lot of people will be there, and there in those days there will be about 5 children, 10 children and things like that. So a couple of them will stay back in the village and take care of the parents, and rest of the children may move to a bigger cities. But now having these people moved, that means we moved to the bigger cities and things like that. So our next the children, like there may be either one or two or none. Okay, in those kind of situation, so what is happening? When they move out to other countries or various places, so these people are alone. So that is the time the senior living has become a necessity kind of a thing. So over and above that, to fund their own living, okay, so the reverse mortgage is a big boon.
Okay, Prashant, let's in IIM, you have done a lot of studies around reverse mortgage. So I want to ask you, Mr. Verma talked about how it's a product that was very carefully thought about and crafted. Mr. Anantram is talking about how it is the need of the hour. However, if you go to the banking sector, out of every 20 branches I visit, only 2 managers seem to know what reverse mortgage is and how it has to be addressed. So even though it is as a product a couple of decades old, it is still a new product. And also there are a few problems that I have seen. One is that it's like Mr. Anantran said, the house that they may be staying in may be worth a couple of crores or more than that. Large houses, people who are the wealthy, they live in large houses. But when you go for a reverse mortgage of that property, what you get is actually a very, very small amount, and it is more like a subsistence amount that is coming to them rather than managing the lifestyle that they're used to. They have a requirement of a good lifestyle, but they don't have the cash flow. They are asset rich and cash flow. So, what does your study show?
Yeah, so asset rich but cash poor is the name of the phenomenon. So, Jayashree, first of all, thank you very much for having me here. It's a pleasure talking to you, and it's absolutely a pleasure to be having a discussion with Mr. R.V. Verma, whose work I've been following for nearly 2 decades now. He's a pioneer, and we are simply following his footsteps when it comes to reverse mortgage. So, yes, at IIM Ahmedabad, we have been studying about this product. What are the merits of the product? What are the challenges of the product? A couple of years ago, 2 of my MBA students did a study on a portfolio of reverse annuity mortgage loans issued by a large lender. And we incorporated all sorts of risks that a lender can be faced with. These risks are, we can understand them very easily. First risk is the upkeep of the property. So when a senior citizen reverse mortgages her property, the motivation for the maintenance, of course, goes down because eventually the property will not be theirs. The second is related to litigation. So if this kind of a product is missold, as Mr. Verma pointed out earlier, then there may be mistrust with the legal heirs. So there may be litigation costs involved. The third is the risk of longevity. So when a reverse mortgage lender underwrites a loan, he has a particular maturity in mind. And if for all good reasons, the mortgagor outlives that, then that risk has to be managed. And the fourth is not necessarily a risk, but it's a challenge related to taxation. So I was hearing very diligently about how carefully NHB introduced RAM as a product in the market. They did a lot of work on sensitizing both the policymakers, the RWAs, and the lenders. I feel that it is now time for phase 2 of that policy activism. A product has been launched, its feasibility has been tested, and we have to address the challenges. So that simulation analysis showed that after we incorporate all these risks into a model, a cash flow model, still a lender's average yield would be around 8%, at par with regular mortgage loans. And you hardly have any risk of default here. So that is an advantage. And the total size in the next 10 years of this market in gross measurement would be around $800 billion US. So even if only 25% of the market goes for this product, we're still talking about $200 billion. That is one big market segment yet to be tapped from the lender side. And yes, it is a social product, but it's a social product with profitable business implications. So why is it that lenders are still not excited about it is a puzzle. So recently I submitted a report to the National Housing Bank where the purpose was to see what the challenges are. I mean, why is it that both the demand and supply side haven't shown the kind of excitement that in all their financial prudence they should have shown for this product? We talked to many experts. Mr. Verma was one of them. We talked to many lenders. And we came up with a few findings. And now that the budget season is close, it's time that the government really took this policy measure more seriously, and perhaps with some sort of an activist mode, because the senior citizens of India are going to be the defining part of Indian demography in next couple of decades. If you look at a study given by Reserve Bank of India, it shows that the income of seniors falls sharply after the age of 60. but this is also the time when they need the income the most, because they're looking for their financial independence and autonomy. Their assets do not peak at 60. They peak at the age of 70, and then they start to fall. So what is the puzzle here? The puzzle is that most of their asset is stuck in real estate. So they are asset rich, but they are not able to convert it into cash flow. So reverse mortgage gives them a chance to do that. So what are the challenges? One challenge we realized was related to perception. It's a social product, and we need to do more on sensitizing the demand side on the benefits of reverse mortgage. There's a lot of misperception about this product itself. It's not really a mortgage. It's an equity release product, to be frank. I mean, a senior citizen worked hard for decades to build that asset, and the senior citizen has full right to consume that asset during their lifetime. So all they're doing through this product is releasing the equity back so that they can consume it. They're not really, giving their asset away to someone else. They are consuming the asset, which otherwise cannot be consumed. So we need to reposition the product a bit, give it a different spin in the social circles. Rather than calling it mortgage, perhaps call it equity release. Second is we go full throttle on awareness campaigns. And this is where the government may have to allocate some budget through media campaigns and through many other ways to just spread awareness about why this product is good and what are the merits of the product. The second challenge, as you rightly pointed out, Jayashree, relates to the lenders themselves. The lenders are not aware that A, it's going to be a very profitable and very large market segment, and B, this is good both for the lender and the mortgagor. And someone needs to tell them. When we were interviewing lenders, they were very wise, very informed people, but they had a lot of misgivings about this product. And lenders themselves also have to take this project up to sensitize their forces, the sales force, and managers at different branches to learn more about reverse mortgage. We also need to go more seriously on building some sort of an institution which takes it up as a cause, because NHB has been working on a mortgage securitization agency that will be a reality very soon. And with a good pipeline of reverse mortgage loan portfolios, we should be able to securitize them as zero coupon bonds. So we need to set up an independent institution that works on the promotion of this, because this is not only going to help the economy, this will be very helpful for the society as well. And then I have suggested a few policy measures, which is based on feedback from many experts on reverse mortgage. One relates to qualifying reverse mortgage loan as priority sector loans. So this will encourage many lenders to consider this when they don't have other options to fulfill the PSL requirement. Secondly, the underwriting standards need to be tweaked a bit. Right now, one has to be 60 years old to avail this. Well, US has 62 years minimum age as well, but they have 8 years more in life expectancy than Indians. So ideally, in India, we need to reduce the age to 50 years. So a homeowner should be 50 years plus to be able to avail reverse mortgage. We need to put a cap on the interest rate charged by the lenders. That has to be regulated. In India, reverse mortgage loan can only be availed if a senior citizen is using that collateral asset as a primary residence. That is not the case in many foreign countries. We have to give that flexibility to senior citizens. They should be able to offer any asset, primary or secondary residence, or even commercial holdings, as they have done in Taiwan, to be able to unlock liquidity from assets that they have. And this feedback came from Mr. Chakravarti, who used to work with Mr. Verma at NHB. And there is a major problem with the taxation. So if you look at the cash flow of reverse mortgage lenders, they continue to give annuity for several years, which accrues interest, and that interest has to be recognized as their taxable income. So they also end up not only paying the annuities to the mortgagor, but also taxes, because this is taxable income. So we need to rationalize that taxation regime for this as well. Sometime in the future, when the loan matures, these lenders should benefit from indexation and long-term capital gains. So I have a bunch of other suggestions as well, but there is so much to be done. This is such an exciting project for as a social good as well as for the growth of the economy that we have a lot of talking to do. We have to build more excitement around it.
Mr. Verma, I'd like you to pick up this angle of the insurer. The insurer, of course, Prashant picked up the point about how the banks are not so enthused because they have to pay their taxes today when they are going to recover their asset value only 20, 30 years down the line, right? So many bankers pointed out that as a stumbling block for them. But what about the insurers? This is a paid up, normally it's a paid up asset. So what is the risk for the insurer?
Right. Yeah, that's a very good point. And I think the insurance companies, life insurance companies, as well as the insurance regulator, they both have to be fully sensitized, and they should be made aware about the necessity and the criticality of this kind of a product. So the while doing the converting the mortgages or the outright purchase value or the value of the property, which is kind of given by the banks, sanctioned to the individual, but transferred by the banks to the insurance companies to buy annuities for the individual. So we are integrating two markets. One is the banking sector, the financial market, and the insurance market, that's the annuity market. Now, they're not totally synchronized. I think that the annuity market is still to develop, and that market was not really meant for a product of this kind, but they have to innovate. They have to be more kind of, confident about this kind of a product, so that their expectations around the annuity should go up, rather than being very, very conservative on taking, the longevity risk. That's a risk. But then they have to look at it a little more favorably as compared to other products. The insurance companies are making good money. I mean, there's certain gestation lag period is there initially, but they're making good money, and I think it's a very profitable business. But some products could be cross-subsidized also. So that is one area is cross-subsidization, where the annuity has to be more market-oriented, where if there is demand, then they can lower margin and higher base kind of approach should be adopted by the insurance companies. So one point is definitely insurance companies and the insurance regulator have to be fully on board, and that's something which both the National Housing Bank as well as the Government of India has to do. That's a very important piece of work which will need to be done, and that's where a lot of advocacy work comes in, and some institution which actually owns up this product and processes, etc., is able to advocate the cause more, emphatically and more, significantly across all stakeholders. So insurance is. I won't talk about the risk gets converted, or rather transferred from the bank to the insurance companies. Now, banks are fully protected in terms of value of the property. So they are giving a loan up to, say, 60%, 62% loan to value ratio of the value of the property. So I would like to suggest that there has to be more flexibility across the banking industry, across the mortgage lending industry. There has to be more flexibility, more customization of this product. Now, customization could come in several ways. One could be interest rate itself, depending on how confident they are about the property value. The other could be maybe the valuation. The valuation is an area which is not, again, very uniform or standardized across the industry, and so much depends on valuation of the property. The entire annuity, ultimate annuity which the borrower, the mortgager, reverse mortgager gets, is based on the value of the property. How the banks are looking at that value, how the banks are looking at appreciation of that value. So there has to be some kind of, which Mr. Anand talked about, the inflation and their income not keeping pace with the inflation. So there could be some built-in, upgradation in the income based on the appreciating value of the property. That's something which the banks have to be very confident about. So these are the areas of learning, and which the banks on the one hand and insurance companies on the other hand. They both have to be, collaborative partners in this whole exercise, and there has to be a good understanding of the product, everybody on the same page, and they should try and address the issue of risk is pretty much addressed in the sense that the value of the property itself would take care of the amount of the loan or the amount of the loan given for purchase of the annuity. Is the longevity risk which eventually determines the annuity or the monthly cash flows which comes to the individuals. And that's where I think the insurance companies have to be more confident. And the annuity, the model, the tables, we see very archaic annuity tables, but that has to be somewhat, brought up. In fact, has to be innovated. There has to be some kind of rethink by the insurance companies. So I think if all these partners come on board and together to really give it a big push, which can come from the advocacy of the government. Government should come in with fiscal concessions, as Prashant was mentioning, which is very happy that they are recommending in his report. And his report can definitely be a very strong advocacy document. So the government should come in by way of one is priority sector, of course. The other is where some kind of concession in the tax gained or the income of the lenders arising out of this particular reverse mortgage, that should be looked at more favorably. There may be some tax concession will be a good incentive for the lenders to really come forward to lend in a big way. And should be clarity around the continuance of the tax exemption on the annuity income which comes to the reverse mortgager. So there should be more clarity on that in terms of the tax authorities. The policy is one thing, but then people, the tax assessors on the ground, they may have a different. So there has to be a good advocacy around this. Fiscal concessions, priority sector, more customized product in terms of depending on the profile of the borrower and the profile of the property. It may not be one size fits all kind of a product. It could be different customization. So we should be a big help. And that will also mean that the lenders and the insurance company will have to do more work when they're customizing. So they'll get a better insight. They'll have to develop a better insight into the profile of the reverse mortgager, the properties. The property valuation will need to be more up to date. The valuation technique will need to be more automated or more uniform and standard across the industry, so that all these rough edges get sort of smoothened out.
There is one more issue that Prashant raised, which is that when once you put your property on reverse mortgage, the incentive to manage that asset does not. One, as you grow older, it is more difficult to manage your assets, and two, the quality of the asset for the bank. The quality of the asset is so important because that unlocks the valuation over a period of time. So should there be a third component here of management of assets? Because I've noticed that whenever the banks, after securitization, banks are flush with a lot of properties, but the valuation actually depends also on the asset quality, which we have not factored in as a institutional.
Yeah, you're right. I think this exercise happens at the time when the property is being underwritten, when the lenders are actually valuing the property before they decide on the amount of the value which can be converted into annuity. So it goes into their calculation, the upkeep of the property, what kind of what is the status of the property at that point of time, how long will the property, both the things are there, with the longevity of the individual and longevity of the property. So the upkeep of the property is an important component which gets built into their calculations to a certain extent. It's not very specialized, but it does get factored into their calculation of the amount. If the property is not in good shape, if it's likely to deteriorate very rapidly, then probably the bank may take certain stand. While other properties where they are convinced about the upkeep of it, or there is some kind of a maintenance agency is there which is responsible for that, they may take a different view. So that's how it will vary from individual to individual, from property to property. But yes, you are right, to make it a more efficient market, where the lenders don't see more risk in that, and they kind of, if they factor that risk into either the interest rate on the reverse mortgage, which ultimately has to be realized out of the property value, then the risk is not really fully articulated, not fully addressed. So to mitigate that risk, yes, you are right. I mean, there has to be some kind of a mechanism to convince the lenders that yes, the property is going to remain in a condition which will fetch them enough value over and above the total loan outstanding. So that's what the lender would be particular about. That at the end of the day, the value of the property, even the deteriorated physical shape of the property, is able to fetch them enough value. So that's a comparison which the lender does at that point of time. And in their assessment, they will also look at the profile of the reverse mortgager, his own other commitments, other cash outflows, how much money is he going to have eventually to maintain and for the upkeep of the property. All that enters their calculation the time when they are underwriting this particular RML. As this market grows, there will be greater specialization. If the volumes keep growing and everybody is on board, there will be more specialist entities come in, which will also mean more professional managers of the reverse mortgages, which are actually assets mortgaged with the lenders, because it becomes eventually ownership in a way gets transferred to the lender, and who is able to possess that property, and it is in his hands. So there could be a mechanism which will kind of foster that relationship amongst all the 2-3 people and ensure that the property's upkeep and maintenance is done pretty efficiently to the satisfaction of all the stakeholders.
Right. In fact, that was the point I was going to ask Mr. Anantram. As senior living facilities managers and operators, what they are doing is they're creating an asset which is especially for the seniors. And it is in their interest to see that property remains viable for a longer period of time, especially since the seniors today can live for up to 30-35 years after moving into that facility. So, Mr. Anantram, my point is there are two questions I'm asking here. One, if I buy into a senior living facility, I have to pay a monthly fee, whether it is for management, food, whatever, right? Medical facilities and so on. I pay you, and it is already built into the model. The second, the seniors who move in there, they come at a time when they have stopped earning. Their earning capacity has come down. They have saved whatever money they have. Their liquidity is locked up into whatever investments, which should see them through the next 20-30 years of their existence. Now, suppose there is a crisis, a medical crisis, whatever crisis, and our children cannot afford to keep them, maintain them at the same pace anymore. After about 15 years, when the person is significantly older, if they find that their savings have been eroded because of a poor management or whatever, what happens at that stage? As operators, I've bought into the facility, I'm living there, I've lived there for 15-20 years, and suddenly I don't have enough cash flow to manage that. That's where this whole concept came to me, that if you run out of money, you don't run out of asset. And if the asset can be converted into money, that means that for the operator like yourself, for the resident like the senior citizen, and for the bank, it's a win-win situation. If the three of you can be engaged in a reasonable product, which helps everybody.
Yeah, you're perfectly right. Actually, as all of us we know, like initially when they come, let's say monthly charges will be X amount toward the food and toward the housekeeping and things like that, right? And year on year there will be an addition of let's say about 5% or 6%, whatever it is, depending upon the type of the facility. Whereas the bank interest, suppose if they have kept a deposit in the bank, so the bank interest either remains same or it keeps coming down. Okay, so that way definitely at one point of time there will be a big challenge. Even today, if I have to go and sit in front of my wealth manager and ask them how much money I should have to survive after 10 years or 20 years, he gives me literally an astronomical figure, which is really a scary number for us. Okay, he will tell you have to deposit some 3 crores, 5 crores right now, and then you'll be able to live peacefully. Okay. So, but here, what is happening? The savings is definitely will not be sufficient. Okay, so there has to be some kind of an alternate arrangement which will make, okay, as long as if they have a children taking care of them or anything, that is fine. Okay, but there are so many people like who could be spinsters or a bachelors or widowers or the people who doesn't have the children. So these are all a lot of sectors where they need some kind of a security. Okay, and for me, why the reverse mortgage is important here is, like, I think Mr. Verma should also help me in understand this. See, if you have an FD in the bank, whatever is the amount you have kept, 1 crore, 2 crore, I think the government gives the security of only about 5 lakh, right? In case of if there is any problem. Okay, I know because a lot of our own seniors who have kept money in the cooperative banks and all lost crores of rupees, and when the bank closed or something happened, so they lost the money, and now they are all given a kind of a compensation of about only some 5 lakh. Okay, so is there any mechanism for that also, like where the banks can do an insurance at a much higher valuation rather than just giving away the 5 lakh? Am I correct in my understanding, Mr. Verma?
Yeah, there is a deposit insurance. So deposit insurance, that also amount keeps varying from time to time, depending on the government's decision. So in case a bank goes under, when there is a bank failure, then in that case, the deposits, is that what you're meaning? The deposits are insured to a certain extent. That amount, it keeps varying from government to government. Right now, I think it's about 5 lakhs limit. But depending on which government is in power, at times they do, at the recommendation of the RBI, they do that. But yeah, this is different. I mean, you're right in a way that, that gives some kind of financial security. What we are talking about is a person who is having a house and he wants to continue to live in that house. So that's very strong bondage. Yeah, strong bondage, where one variant of it could be that if a person, he monetizes his house, gets a certain decent amount of monthly income, and out of that income, he is prepared to live in a smaller accommodation on rent somewhere. So whether that income is enough to support him to that rent, and over and above that, he has some money. But here, the concept was that a person who wants to live in his house, he has built his house, he has, acquired a house through his, hard days throughout his life. And then how should he be able to, what should we provide? What should the system or the society or the government or the policies provide to him in such a way that he is able to continue to live in that house, even though his cash flows has come down. His post-retirement, his income is down, and his bonding with the house is so much that there's a large segment of the population who have the sentiments attached to that house, and they like to live in that house no matter what. So rather than living in very deplorable condition, which cannot be sustained, can use the house to get that value and the money unlocked so that they continue to live in a pretty decent kind of a setup.
Yeah, so I was just thinking about your idea, Jayashree. So I like the way you are thinking about merging senior housing with reverse mortgage. So these are two separate products altogether. And on the one hand, we have operators or developers who are building communities that are friendlier to citizens, not only from the physical and design side, but also from the facilities and amenities side. So that is one part of the solution. Reverse mortgage would be the financial market solution. And at some point, we do have to think about how to merge them together. As of now, perhaps we are devoid of models like that. So this is another good direction that we need to build.
Yeah, just to add to that, while we are on that subject, that's where the intersection of the individual needs and the community and the social needs that comes in. The community living, how can we set up the whole context? That's the ecosystem around reverse mortgage, so that both on the demand and the supply side, there are good amount of suppliers, but suppliers would normally provide this kind of community living where senior homes are there, and people are able to live in that kind of house with maintenance looked after, including their health, insurance, shopping, everything, movements, transportation looked after. And whether they have done a reverse mortgage, their bigger property, and converted that into cash flows, and then living in that house on rent, is something which brings together both these concepts: the individual need through reverse mortgage, and the supply side, where you have the builders coming in, or the professional estate managers coming in to really be able to support the senior living. So we may have to find a way to somehow get that intersection done very efficiently.
In fact, that intersection is what is important, because Mr. Anantram was telling me how the consumers have different requirements. Some want to buy smaller units, some want slightly bigger units, some want to come on lease. Mr. Anantram, why don't you explain the psyche of the seniors when they come to you?
Risk in the properties which are available and given it to the bank for the reverse mortgage. So suppose if that particular the property of the asset, if it is sold, and if that is invested on a senior living kind of a project where it is well maintained, okay, and the banks are also having the risk free, in the sense they know that, okay, this asset is a good asset, and then this is also will be maintained well by the community. There are so many communities, they do so well, and all the communities, they take care of the assets very well, and then they take care of the buildings very well, repainting them on a periodic basis, maintenance on a regular basis. So all these things happen. So that way, and there is always a demand for that particular unit when they want to resell it. Okay, so the banks, if they think that, okay, there is some kind of a non-performing asset, I don't want to get in, but if they are able to service the senior living properties, okay, for this reverse mortgage, it will be much risk-free kind of a thing. Okay, that is one of my submission. And the second thing is, when it comes to the risk, also, like I want to give a live example in my own friend place where what had happened. So this person, a senior living couple, they had about 5 children, 3 daughters and 2 sons. Unfortunately, both the sons who are of in the prime age of around 40-45 years, they passed away in the accident. Okay. And so then this person was an ex-banker, like he was working in a bank. So he knew about this, the reverse mortgage very well. I'm talking way back about 10-12 years back. So he went for a reverse mortgage, a very prime property in Bangalore. So he lived there happily till his end. Then after that, his wife, once he passed away, his wife continued that. And she was also lived peacefully till her end. And the 3 daughters and 2 daughter-in-laws, so later they were able to take back the property from the bank by clearing the rest of the loan, because by then the property value had gone up nearly 10 times. Okay, so the what they paid to the bank was very meager amount. Okay, whatever he had consumed, because it was something like a OD kind of a system where monthly only he will draw a certain amount what is needed for him. Okay, and that's it. So they got it, and now the property, the children and the daughter-in-laws, they have developed it so well, and then all of them are enjoying the property. Okay, so that way the risk is not there because of the kind of the price hike which is happening across the country. Okay, it's not, I'm not talking about Bangalore, even in the tier 2 cities, if you go today, the prices are shooting up like anything. So definitely banks don't have that much of risk. Okay. On the other hand, for maintenance, if it is especially the properties maintained by the communities, it will be really good. Okay.
Also talk about your lease model. You have a lease model, right? When somebody sells off a property, they can put a sum for the next 5-10 years. It services the payouts, right?
Yeah, so here there are so many models available. Either they can buy the units, okay, for themselves and pay only the maintenance charges, or they can, instead of just buying, that means investing the whole money on the property. If they want to lease it out, okay, they can, if they have a property elsewhere, and then they can go for a long lease, or the monthly rentals are available. So there are so many various formats of senior citizen the centers or the units are available. So any of this format will fit in if they have the real estate, if they want to put it on a reverse mortgage.
Prashant, one last question I want to ask you is, what can be measured is what can be analyzed. Today, all these various elements that we're talking about, valuation, the returns, the risk value, all that, and is today a little cloudy. Everything is not measured, and it is not a very scientific exercise. As an academic institution, don't you think that you guys can actually create models for actually capturing this information, so that when I see it's the value of a property, does the value of a property really diminish, or does it actually enhance? Today it is mota moti itna hota hai, but can we actually determine what that value of the property will be for the insurer, for the bank, for the resident, and for the senior living operator?
Absolutely, you're spot on there, Jayashree. So we do have some modules like this in our classes at IIM Ahmedabad. Not everyone has the time to come here and attend the classes here on a lighter note. But Mr. Verma talked about the actuarial risk. And for the benefit of the audience, with your permission, I would like to talk a little bit about it. That reverse mortgages can be of two types. One is where a lender commits to annuities for a fixed term. So I'm a retiree, I go for RML, and the lender signs, let's say, 20-year reverse mortgage annuity for me. So after 20 years, the cash flows from the bank to the homeowner cease to exist. And if the homeowner still survives, it starts to accumulate interest, but cash flows stop, right? So that model does not really have a lot of probabilistic risk there. So if the homeowner outlives that term, the lender is not exposed to any cash flow risk there, right? The other model is sort of a pension until the life of the homeowner. And that is where these probabilistic calculations come in. So with the availability of longevity data using analytics, it's really not difficult nowadays to simulate a portfolio of a reverse mortgage lender and estimate the risk, and then price the risk either into loan to value ratio or in the interest rate. So that really is not a problem academically. We have the data, or we should be able to source the data, and we can do all those actuarial modeling to make sure that if a lender is exposed to this kind of a risk, how much of extra return or interest that they should be charging. So yes, I mean, absolutely, academically, we do have a solution for that. And we wish we are able to apply that knowledge in the industry.
In fact, the challenge is to bring it from the labs to the market, so that these models are actually utilized, right?
So medical doctors developed this model called hazard model, which is about the modeling of mortality of individuals, right? So when you have a long portfolio of homeowners who are going for reverse mortgage loan, it's really not a big challenge to incorporate that risk and price it accordingly.
That brings me to the point of, this product, it should be made accessible, number one. Number two, it should be affordable. And number three, it should be adequate. So accessibility, affordability, and adequacy. And all these parts which Prashant mentioned, that it could be, say, adequacy could be higher loan to value. Now, higher loan to value, say 75%, 80% of the value of the property, the lenders will give only if they are confident about their calculations of the valuation. And that's where the data analytics comes in, the trend analysis, the data analytics, and they should develop that kind of professionalism to be able to be on top of it, on top of the valuation. Before it starts, they should anticipate that after so many years, the prices may behave in a different way. So that's the kind of calculation and the simulation examples can come from the lab to the market. Similarly, in terms of affordability, this will be adequacy. So higher amount will be available, higher annuity will be available. Affordability will be by way of some interest rate concession. Now, the more the lender becomes certain about the risk and his ability to manage the risk, understand the risk, manage the risk perception comes down. So he'll have mitigated that risk, and accordingly the price of that will come down. And in any case, he has security of adequate value. So there are no collateral risk, no security risk. So these are I come back to the original point which Prashant was mentioning, that positioning of the product is very important. How we position and project the product to the market today in terms of accessibility, that is, there has to be lenders, there has to be insurance companies who are able to offer this kind of product, and there has to be institutional mechanism for the people to have access to this particular facility. It's a very sensitive product. It can't be oversold. It can't be aggressively sold. It has to be sensitively sold. And with all the information available to the people, because they're senior citizens, they can't take another chance. That's probably the last chance that they'll be taking in their life. So they can't be misled, or they can't be misinformed. They can't be mis-selling. So those are the areas which the regulators have to be very particular about. At the same time, accessibility through institutions and the product, and the customization of the product. Number two is affordability by way of some kind of interest rates, risk mitigation measures, and adequacy through a higher loan to value ratios, or the lenders appreciating the value of the property, and even appreciation in the value of the property can be brought forward. They can discount that or provide some kind of premium on that upfront, so that the market, rather than giving them at the time when the actually property prices go up, they can do it initially and then look at the behavior of the market. They can have variable annuities also. I don't know how it will be possible, but variable annuities depending on the valuation of the property. So which would mean that you are covering the system, ring fencing the system from certain risk in the property valuation and also the longevity risk, and providing some variability in the outflows so that these risks are also get addressed.
Yeah, very true, Mr. Verma. Like, we can also do some sort of a reverse plan here. So price level adjusted mortgage, we can revert it. So in higher inflationary environments, we should be able to increase the annuity. And with analytics, all of this is possible, Jayashree. Mr. Verma is spot on that what is happening nowadays is that a lot of lenders do not know the risk. So they overprotect against it. And that is what makes LTVs go way below, and which is a question of adequacy. And that is what also makes it less affordable, because they ramp interest rates up. And they're doing it for good reasons, but we need analytics to make it better.
And with people like Mr. Anantram, when with senior living facilities organizations, they are aggregating the demand. So, you will be able to do your studies. I would love to see a scenario where Anantram and many others like him, ASLI is the organization of senior living operators. So what happens is this: they could come to you. They're bringing standardized data. They're not bringing random broken data. But if that data gets analyzed by a premium academic institution like you, with access to advisors like Mr. Verma, somewhere we will see that despite the fact that there is the RBI involved here, there is the NHB involved here, there is IRDA involved here, but at the the center of that social requirement is the need. And as a journalist, I could see it as a bird's eye view, because I was talking to everybody around, and the problem seemed to have a intersection point, which is why I started this conversation. See, this conversation is just a beginning of a series of conversations we're going to hold around senior living, because it is our senior living population is growing from 7.1 to 12 point something percent in the next, I think, 7-8 years. With such a rapid aging population, we have to find the solutions today so that the crisis doesn't hit us before we find the solutions. The solution should be available when the populations are aging. Thank you so much, everybody, for joining me. And keep tuned into this conversation because it's important for all stakeholders. Thank you.